Hello everybody, this is JW Nigerian with the Commercial Real Estate Professional Investor Group and my friend Leo Manriquez, the President of Commercial Real Estate Distressed Assets Association. And we're here today with Bob Kline of, let's see, you're with RW Kline Companies out of Scottsdale, Arizona?
Yes.
Last guy we just talked to was saying bad things about Arizona.
Arizona's a tough spot, but you know what? It's out of our 11 offices, it's our least productive market sector. And Arizona, as bad and fast as it went up, came back very fast the negative way. And so as we rode the market high, it was great, and then we crashed. Our recovery there has been almost, I won't call it non-existent, it's just been kind of bumping the bottom. I don't think everybody knows what's going on. There's a lot of stuff, a lot of office still there, a lot of retail is still in play. The multifamily sectors you heard. You know, different deals, different places, but it's no longer ground zero. I mean, without doubt, we would go back to Vegas, certain parts of California, certain parts of Southwest Florida. There's clearly still ground zero. Yeah, if I look at volume of work that's running through out of each state, Arizona's probably one of the lightest ones we have, and it's my home office, so it's kind of ironic that way, but that's where it sits.
Okay, so Mr. Kline, tell me about, you're speaking at the Green Pearl Summit here, Distressed Assets.
Yes.
So I'm guessing you're speaking about that?
We are speaking about distressed assets. We're speaking about the basically, you know, how to go out and try to acquire acquisition of either notes or assets through the process, through receivers, through the REO process, through note sales, bulk buying comparison between CMBS and balance sheet debt. We spend a tremendous amount of our time with CMBS debt as well as balance sheet. We have two different teams that handle that, and the CMBS sector right now is the more prominent. As an investor, I prefer to buy into the CMBS sector because of the carve-out guarantees and people filing bankruptcy. If I go buy a note or an asset for one of our funds and it's on a balance sheet debt, obviously I have to worry about the bankruptcy provisions, and you can't prohibit that, so it's just the luck of the draw. You factor it in your deal and you hope you can work it out. But that's
So you're buying for funds, you're also buying for syndication?
We buy for syndication, we buy for funds, we buy for ourselves.
Right.
We do a tremendous amount of loan restructuring. Our company is basically CMBS and balance sheet debt restructure across the United States. We do balance sheet debt restructuring outside the United States. And we have a note sales operation where we basically are bringing notes and selling them to our funds that we have that are in our stable, so to speak. Consistent and reliable to close. They're quick deals that close, and our average note sale is about 14 days on average. 17 is the high side. We've had one go to 30, and the note sales range anywhere between $5 million to $300 some million. Our net average is about 13.1. That's the net out value today. And we just this morning actually finished our 297th, so we're trying to get a 300 mark. That's all in the last 30 months. So the activity is obviously bumped forward in that time frame.
Right, and you know, you're going to be busy for a while because I understand CMBS is going to be having issues all the way into 2015.
Well, you've got the maturities in, maturity defaults coming up. We've got the current distress that sits out there today. We've got a tremendous amount of paper that was written or underwritten, maybe with not the best, thought process. I think at the time it was, but obviously nobody certainly realized we'd be in the crisis mode that we're in. So you've got such a devaluation in most of these KIP markets that now the position of what's moving forward versus was supposed to move forward is far less. So you've got a lot of people underwater, equity's gone, just as in balance sheet, but now you got a securitized scenario. So you got multiple tranches that own 1,000 loans at a shot, and they have to go through that, but the servicers and figure out what they're going to do there.
Do insurance companies like you, or are you just...
Well, I'm a developer at heart, so and having worked myself out of a massive debt in the early 80s and paying it back at par or par negotiated, I understand where the lenders need to come, but I also know what it's like to have the gun to your head, so I can look at it from both perspectives, and our team does. Most of our team, as far as the insurance companies or lenders, are former lenders or former FDIC guys or former RTC contractors, and on the CMBS side are former servicers or underwriters for the servicing. So they have that rapport back into them. I use the entrepreneurial approach, I let them use the technical approach, and then we mix it together kind of like a credit committee. So the insurance companies have come to us a lot for doing basically going into their portfolios they bought or already levered into and trying to restructure from top down, or occasionally they'll have us work from the bottom up, from the borrower up. We used to be 80% borrower, 20% lender. Now we're 20% or 60% lender and 40% borrower. And that seems to even be shrinking more and more and more. But even if we're on the lender side, and I've lost some lending engagements because I'll tell them, look, you're going to always monetize that asset better if you can keep the borrower in place, providing they didn't cheat, steal, and lie, and they're a good party and they have a good plan. And if they have skin in the game, that's even better. But if they don't, sometimes that's not a variable. Throw them out.
So you're saying you opt that they work with.
You're going to monetize the asset all day long at a higher multiple for the existing borrowers. Always more interest. I think it was said before at the conference, as well as in some previous interviews here, that you're going to have people that are going to have that love for their deal, and so they're going to give a little bit more if they can. Now, if they're exhausted their means, and don't get me wrong, several people come and go and say, look, we can't take the battle anymore. We don't want the fight. I started with black hair and now I got gray hair. I think the reality of it is that the expectations is the number one deal for everybody involved. And if they have the right expectations going in this, whether it's the lender down or the borrower up, you can come to some kind of resolve. And then you have the regulatory issues that really are your final filter. And either you can or you can't do the deal based on capital, based on reserves, on balance sheet debt, whatever may be the case.
I'm going to back up on you a little bit. You mentioned bulk. There's a huge market out there. I believe it's mainly phony, of bulk REOs and bulk notes sales and supposed buyers and supposed transaction. Are you privy to that at all?
We are, and we just spoke about this in our session here at the Green Pearl event. Basically, on the bulk buys, the FDIC buys are one, and then you just got bulk patterns going out there. The auctions are becoming very popular.
Right.
A lot of people love it and had a big fun in there, so they loved it to death. I have mixed reviews on it. I think they're run well. The question is what quality assets are in there.
Right.
However, the advantage of the auctions, you have a little bit more flash to it. If you're going to go out and buy a bulk package, and we were describing where we'd go out and do advanced due diligence for bank takeovers or for packages like this. If you have 300 assets involved or 400 assets and you only have a month to do it or 2 weeks to do it in some cases, you're going to get through the top 30, 40%, and then you're going to have to average the rest. So you're going to have a database and understand what you're looking at. And so you have a little fluff built into it to cover yourself and hedge your odds, but you have to be very careful. And so I prefer, we've stayed out of the bigger deals. When we do our note sales and pools or anything, we usually do 1 to 10. There aren't a lot of one-offs, so to speak, but when they do come about, we do them. A lot of those are generated through our as we're doing our disposition work or doing the restructuring. They come about where either the borrower can't stay in place, and we want to go ahead and buy a discount.
So you're not just talking to asset managers. You're actually working with banks that are being restructured?
The banks are either being restructured or in more cases acquiring those restructuring banks, and we are a subcontractor to go in there and do an analysis on the actual physical real estate that's held in title or UCC filings, whatever may be the case, because a lot of cases they've over-levered those, so we have to go in and give them real values, right, as opposed to a real estate broker giving BOVs or an appraiser appraising them.
Are asset managers also calling?
Yes.
Okay.
A lot.
A lot. Because they don't. There's a lot of people on the street that are talking to the asset managers, and they get the same list.
I think they're overloaded in one aspect. I think the other aspect is that there are closers and there are shoppers. And right now, if you picture a wagon wheel, and the center hub is $100 million, and this has actually happened, so this is a factual. It happened in Phoenix. A gentleman showed up with $100 million to buy distressed assets. Well, he was smart. He went out and figured, okay, I got to put this to work, so I'm going to get 10 people working for me trying to place this money. Well, now I have a wagon wheel hub, and I got the spokes all going out. Well, the market thinks there's $1 billion because there's 10 people out there floating around. So in reality, there's $100 million of real cash. Now, I happen to have talked to that gentleman the first day he came to town, so I knew where the money was, but a lot of people didn't. So we had lenders and even a couple servicers in the CMBS saying, oh, there's a ton of money showing up there, we're going to sit and park it out and wait. And reality was that $100 million wouldn't cover that billion spread. There's a ton of money out there, but the expectations on the money on the returns is very high, and the levers don't quite work in most cases. The REITs seem to be very aggressive and be able to price down. The money coming from Asia is very well priced, so it can go in there. But unless you're buying mezz debt, and then you can get the higher returns, and then it's higher risk.
Right.
So, and that depends on where it is.
Hey Bob, you were saying that you work with brokers and in our earlier conversation. How do brokers participate with you?
Well, brokers, it's ironic. Brokers, on one hand, got to ride the ride up and sell a lot of stuff to a lot of people for a lot of money. And then they were afraid because not knowingly, but the market changed and now all that value is gone, so they're afraid to go back and talk to those clients. And our philosophy, and it seems to have proven out fairly well in multiple MSA markets, is that the broker reach back to that person in trouble, either engage a professional firm to help them, or maybe they try to help them themselves if they understand the deal and understand the complexities of the financing, to restructure that deal and kind of be their little internal hero and gain that client back so that there's no negativity. And most brokers, I would never call them, gosh, he's lost $2 million net value on the deal and he's broke on that deal. And I was like, no, you know what? You're the last person I expect to call, but they'll appreciate the fact you came back to them. You made money on the front side. Now come back and try to help them on the back side. And if you can, you would be, hopefully you get a new listing. In worst case scenario, the lender is going to look at you potentially as being the broker of record to sell the asset because you know it better than anybody. So there's really not a negative. Are you going to get hung up periodically or called bad names? I'm sure that happens. But a majority of the brokers we talk to about this, they become a great source of leads for us and create our pipeline for doing restructuring work, but also as far as value of actually creating deals that get to the market we can actually buy.
So as a broker, if we I work with a lot of brokers, and maybe they have clients that have a bad loan, and maybe the broker doesn't know how to handle it. They would just refer it over to you, and your team would handle it?
They would refer it to us. We would engage with the counsel or with the borrower. A lot of times we do counsel because it keeps confidentiality tight, so we don't have to worry about that from the borrower's aspect, providing we're not conflicted out on the lender side. A lot of guys play one side or the other, and we have two different distinct companies. One plays one side, one plays the other, but we still make sure there's no conflicts. But the brokers would refer us to the borrowers. We engage with the borrowers or their counsel or both, and we try to do a restructure package. And then at the same time, we're also trying to look to bring in capital, whether it's a white knight lending scenario or whether it's full takeout money, or if maybe we think this deal can have a discounted payoff, then we're going to make sure there's enough money behind it to make it happen. So if the borrower's strong, as I said in the beginning, I'm very much of a borrower developer's friend, and try to be at least as best as possible. And if they're strong, have a good business model, and just the economic times caught them, they're far likelier to get help. If they have an ability to inject a little bit of cash or equity to a deal of some collateral, even better. It makes the deal much smoother for both our job to present it to the lenders as well as the lenders to accept it. Just as if I was on the lending side, that's the first thing I'm going to want to see. I want to know where the money is. Do you have money to take this out? How are we going to get across the finish line? Otherwise, we're wasting each other's time and legal bills and consultant bills.
Sure.
Who's your perfect client?
Perfect client is somebody, in all honesty, a perfect client is somebody that is not in default today, that is coming in default. We see a lot of people that are running out of steam. We know that in past cycles, you kind of come up the hill. It's kind of like a roller coaster with that bar in it. And a lot of these guys, not a lot, but a lot of people have done investment where they bought a little too high in the market in the last 2 years,
right,
thinking they got a great deal. 40 cents on a dollar, well, 40 cents on a dollar that's worth 30 is no great deal. And we see that, and it's happened time and time again. But those deals are 3/4 of the way up and they fall out. So our perfect client is either trying to get them funding to restructure them or buy that type of deal. Or in the very beginning, we tell everybody, if you think you have a problem, you're going to have a problem in 6 months or a year, whatever it may be a problem, because you're losing that tenant base in 2 years or in 6 months or 18 months, let your lender know. Be transparent about that part and go to your lender first. And then if you can't, you get a little pushback or you want to have somebody professionally talk to the lender on a dialogue basis of lender to lender type of scenario, then you would get a firm like ours or others that have that ability, and we would go in advance and we try to structure it before it becomes a problem. If we can keep it into an accrual basis versus non-accrual, it helps the bank on their balance sheets. It makes the process much better. And in the old days, banks really wouldn't talk to you till you missed a payment or whatever. Now, if you call them, providing they have the manpower to take care of it, they'll be there for you.
That's good. We've talked to a few people today, and that seems to be the general theme, and that's call your lender. But because of the denial that's going on about something's going to happen, and I won't have to lose my property, and I won't have to go into default, and the banks have been extending and pretending maybe they just won't call me if I don't pay, all that kind of stuff. You're kind of saying, and a lot of people have said, Find out where you're at. Call your lender.
No news is bad news. If you haven't heard from your lender, but you know it's not good, that's not a good sign.
Right.
The lenders, in some cases, technically do not have to tell you anything up in advance. They can, one, either be selling your notes. Number two, thinking about their reposition plan and when they can afford to bring you into REO and foreclose on you. I think that the earlier the notice, the better. As far as a restructuring operation, the earlier we get engaged is better. The earlier the attorneys get engaged. It just makes the process simpler. In all honesty, it saves a lot of money. It's much easier in the beginning. We're like heart surgeons. We get in, get the operation done, and we get out. Okay, right. We're not cheap, but that's what our forte is and our expertise. What you don't want to do is have a 2-year-long process trying to get through the pipeline, unless it's a bankruptcy issue, which we'll extend the time out. You want to shorten it up. Balance sheet debt is much shorter time. CMBS cases take a year plus to take care of sometimes. So it just depends on the type of loan it is.
Okay, so where can the prospective client get a hold of you?
They can get through our website, which is www.rwkline.com, or they can call our main office in Scottsdale, Arizona, which is 480-443-3600. I almost gave you my cell phone number. But our website's the best way to go. They can find out the resources and the different magnitudes. We have numerous pages for lenders, for borrowers, for investors, for capital and equity injection players that want to either put money in or not. And a lot of people have a lot of money, but they don't have the pipeline of the deals. Our restructure operation actually provides those pipeline of deals, so we have probably a little bit better base than a lot see. But by all means, we don't have any secret recipe to knowing where those deals are.
Right.
They either have come to us or we know about them, and we've restructured one side or the other, and we can facilitate a transaction.
One of the things, because you were saying sometimes asset managers call you, one of the things that I hear from people who talk direct to banks is that the issue is there's no such thing as a seller mandate, because the bank doesn't write a note saying that you speak for us.
Right.
But it more comes down to here's the list, and bring me some great buyers. But you don't control that list.
No, and you know what? I see that happen, but more often not, the direction, and I would guide this as an investor, know what you want. Know the type of class of assets you want, the submarket you want, preferably know the exact building or pad or retail center you want,
right.
Know who the borrower is, know everything you can know about it. And by the way, when you come to ask about that for the investment part, as far as doing that, you have to have the money. So you can't shop the deals like you used to be able to do, put them on hold for 30 or 60 days. You must show proof of funds. We vet a lot of deals for banks and for lenders.
You vet in advance?
And we vet in advance. First one's money. Second one, have you ever done a transaction like this? Either an asset or a note sale. The note sales are a whole new ball game. It's an instrument, not an asset, so you have to understand how it works, the process taken over, no reps and warranties. There's a lot involved in that, and
do you have a platform that you guys use? Or
yes, we built our own platform, and so we can vet the system through the process.
Okay.
And several other companies have platforms equal to ours. Some probably a little better, some probably a little worse, but it's worked out very well when we have to do that criteria change.
So you vet the buyer.
We will vet the buyer. If we're working on the lender side, we'll vet the buyer. We'll vet the property. We'll know where it stands.
And only brokers can come into that, or
no, high net worth investors can do it. Institutional investors come in certain times. More often than not, they actually assign us to go look at the assets for them and to pick the ones out of the 10 they like. We'll say, well, these 3 work, these 7 don't, and here's why.
Right.
So it just depends on what it is. But we have a lot of one-offs that come in the door and say, I know my buddy's going to have his building foreclosed, and I don't want to really lend him the money because the bank's going to mess him up. But if we came and buy it, I'll make him my partner, and then we can work in that direction. Or if on the lending side, they'll tell us the same thing. Hey, we want to do this, but obviously you're not going to let him own this asset. But I'm going to own it, and he's going to have a backside piece. Do you have a problem with that? And again, it's back to transparency and being upfront.
Going back to the bulk a little bit, when you work with a bank and you do have a larger bulk of properties in reconstructing, it used to be said, somebody pulled this out of their butt, this number, 20% of those assets are going to be garbage. At least. At least. Is it a lot higher now than it was?
We run an average of 37%, hoping that we end up at 20, because then it's a bottom line field day for us. But you've got litigation costs, you've got carry cost on these money. You know, whether you're going to do 80 bips to cover that loss, if a CMBS loan versus a balance sheet, there's different parameters, but we go by the notes, knowing whether, you know, hopefully we don't have to foreclose. A lot of people have the loan-to-own strategy. A lot of the bigger funds do, and you know, you don't pay me, you're out. I mean, we don't buy a note unless we know we don't mind owning that asset and we can make money on it. There's no sense of buying the note. Just to buy a note to say that's just paperwork, and tedious paperwork at that. So it's important to understand what you want, where you're going to go get it, and how you're going to get it, and then once you get it, how you're going to facilitate it.
Bob Kline, thank you so much.
Thank you. I
really
appreciate
it. That's
Thank
with, say the name of the
R.W. Kline Companies.
R.W. Kline Companies. Thank you so much.
Thank you. I
Great
appreciate it.
interview. Thank you.
Excellent. Thank you.